Horlicks Network 18, Mission Poshan, Bhavishya Roshan.
My colleague Nimesh Shah is at the Morgan Stanley Investor Summit, and he has with him a very, very special guest who can put India into perspective among emerging markets. Nimesh, over to you.
Thanks, Lata. Yeah, you're right. I'm having with me Jonathan Garner, the Asia strategist for Morgan Stanley, and he's been bang on his call on emerging markets, including India, since the beginning of the year. So I'll ask him about all this, and of course about the India as well. So Jonathan, thank you very much for talking to CNBC TV 18, your 20th annual India Summit. You've been very bang on since the beginning of the year on the emerging markets, including India. First, on emerging markets, you think this is parallel to what you saw in 2000? And there is still more pain?
Yes, there are some similarities. Firstly, thanks for interviewing me. It's great to be here in India. Yeah, I think the similarities are manifold. We think we're nearing the end of a global economic upswing that in this case has gone on for 9 years, and we also had one almost throughout the 1990s. So if you look at the way that we come to the end of the cycle, we've got tightening of monetary policy in the US and China, the two largest economies, tightening policy at the same time. We've got the oil price starting to really act as a headwind to growth, and we've got quite high equity valuations as well. So that's very similar to the 1990s, particularly in big cap tech.
I was looking at a note, and it very clearly says that the upside is capped for EMs, including India as well. Today you wrote a note that now maybe you're seeing a bit of a pullback into the emerging markets. Tell us what do you think right now EMs are, and how much upside you can see from here?
Well, the EM index peaked at 1270 in the last week of January, so shortly after we wrote our year ahead piece. It's fallen almost 12% in dollar terms since then, so it's had a pretty meaningful correction. So that leaves it about 3 or 4% upside to our current target. So tactically, it looks a little bit more interesting, particularly as the dollar is not so well bid here. But strategically, those issues that I mentioned previously, they're still with us, and that means we do have to be very careful in positioning in the market.
I'll ask you about global macros and crude and everything. But first on India, you've reduced your overweight on India by good 150 bips since the beginning of the year. We've already seen a bit of correction, not in the index level, because at the index level, India is just down 4% in dollar terms, Y2D. But there is a big correction in the mid cap and small cap. Your reading on the markets and overall pressure on the mid cap and small cap.
Yeah, so if you look at India, it is still an overweight for us. So it's not as challenged by some of this macro environment as some of the underweights that we've had this year. But you have got that higher oil price in a country which does still run a large current account deficit. I mean, it's not as big as it was, but it's large compared to, say, many other countries in Asia that actually run surpluses. And so we put it in a group that maybe includes Indonesia, that's had to hike interest rates at the end of May. We've obviously got an RBI meeting ongoing now. So it's nothing like the 2013 taper tantrum when India's macro position was worse. For example, inflation was much higher in 2013. But there is that kind of, let's say, tendency that pushes rates up, whilst the cyclical recovery is still quite young here. And again, that maybe comes back to the SME point that you make. For SMEs to do well, you need a really fully fledged cyclical recovery rather than the nascent cyclical recovery we have. But when you put it all together across the whole index, and we do like some of the mega caps here in India, it still ends up as an overweight, but not a large one.
Okay. What is the Morgan Stanley house view right now on crude? And then I'll ask you about your view on rupee as well, because that will impact a lot of IT stocks that you're bullish on.
Yes, that's right. So if you actually look at the crude oil price, we were arguing late last year that it could average $75 on Brent this year. And now recently we've moved up our forecast into the 90s for late 2019. And it's testament, again, to these late cycle forces. We have been in a global synchronized upswing, and that's obviously helping the demand side. But also our analysis on the supply side indicates that the shale supply response is not as big as in the previous cycle, and OPEC supply discipline is likely to be with us. So that is a traditional challenge for India on the current account side. But there are some stocks that one can play that benefit from higher oil prices in this market. So one name that we've owned in our list all year is Reliance Industries, which is very positively geared to that. And then on the rupee side of things, which you mentioned, again, it's one of a group of EM currencies that has traded towards the weak side this year. It's not as weak as some of the other currencies that are more challenged from a macro perspective, for example, the Turkish lira or the Brazilian real, which has done less to close those imbalances since 2013. But we do also want to be thinking here about some of the export earners that exist in the Indian market. And we broadly would prefer the IT services names to the pharma names. The IT services names are much more late cycle in terms of how they interact with the corporates in the advanced economies, which are likely to increase their capex spending and their IT services budget.
Within IT, Jonathan, if I remember correctly, you have TCS in your focus list as well. Beyond TCS, are you bullish on the mid-cap IT as well? Because that's where you've seen massive rally in the last 2 quarters.
TCS is a name that certainly has been highlighted by our analyst team. We don't, in our group, tend to look so much at the mid and small cap names in India because our institutional clients tend to be more focused on the larger cap names.
Sure. You spoke briefly about being underweight on pharma, and we've seen most of the pharma stocks in India corrected and pretty much at a 52-week low. Are you getting a sense now that this is a time to now at least bet on a few large pharma names, or are you still being underweight?
Well, the healthcare sector globally is a very interesting play on demographics, but the Indian firms have had this very strong niche in generics, and some of what we've seen is really regulatory in relation to the FDA issues that some of the firms have faced. And our judgment is right now that we probably would still keep that sector somewhat on a cautious bias.
Okay, coming to the global markets now, at least the global growth seems to be synchronized. How much more rate hikes do you expect from Fed this year? And what could be the potential impact on EM currencies and EM economies?
Well, the Fed is largely, not completely, but it's largely endogenous to the global economy in terms of how it evolves. So I'm not that bothered as to whether it's 2 or 3 hikes. The important thing is that they're continuing to hike and that private financial indicators such as the LIBOR rates have also been moving up. And corporate credit spreads have been widening. So the corporate cost of capital in the advanced economies is rising quite rapidly. And again, that's typical late cycle. China is also tightening and somewhat more difficult to predict on a monetary policy basis than the US. But it's that combination of both tightening at the same time that really ensures that we're in this late cycle environment.
So what are the key risks that you'll be watching out for from a global point of view, which can impact a lot of emerging markets like India? Whether it will be crude or whether it will be currencies?
Well, we've talked about a few things in this interview already, but one we haven't talked about is trade protectionism, which is clearly worsening. And from India's perspective, it's not a very large manufacturing-oriented economy. It does, in fact, some of the, for example, the visas and some sort of licensing and regulatory issues that may affect corporate India, so that's something to watch out for. But certainly for broad Asia, when you look at, say, technology, hardware or autos, two industries that are very integrated in relation to supply chains, they have a lot to lose from tariff hikes that seem to be coming through now, then that is an additional source of risk to the long-run global macro outlook. And there's very significant sector and stock effects in Asia at the moment that are playing out.
Are you penciling in concerns of trade wars as well when you say that the upside is capped for emerging markets? Is that also priced in that there could be potentially some trade wars as well between US and China?
Well, we mentioned this as a risk as long ago as our November year-ahead piece, and as we've gone through each of these, let's say, increases in tension, we have further ratcheted up our concern on that, and we mention it again in today's note. Again, it comes back to the fact that we can have a small tactical bounce here, but we're a long way from being strategically bullish, so it is definitely overall a negative from a macro market outlook perspective.
Coming back to India, while you said that you're still overweight on India, the one reason why a lot of strategists were overweight is because they expected earnings to come back and earnings to revive. We've not seen that in Q4 as well. I've seen some reports where even for 19 and 20, they expect some bit of downgrades to the earnings. What is your general sense on earnings in India, and are they really troughed out?
So Aridham Desai and our colleagues here are slightly lower than consensus on earnings growth, but they do see 2 good back-to-back years coming, and it's been a long time in coming, this cyclical upswing, and it's been impacted by both global factors, but also the domestic tightening of policy post-2013, and then the implementation of GST and demonetization. But there's plenty of indicators around, for example, cap goods imports, the pickup in lower-level discretionary spending that suggests that it is going to come through now. So that is an important reason for actually maintaining a modest overweight in India. If we don't have an earnings upswing for any reason, then the valuations could leave the market somewhat exposed.
Okay. Jonathan, I was looking at a sectoral positioning, and you're overweight on the industrials and the capital goods space. Yes. But it's largely been pushed by the government spending. We still haven't seen the private capex picking up. Yes. What is your prognosis? Is that your overweight on Indian capital goods is largely that the government spending will go up, or do you think now the private capex is going to pick up?
I do think private capex picks up, and indeed capex more generally in the emerging world. And again, remember a name like Larsen & Toubro, for example, has exposure to the to the Gulf region, which was quite a problem for the firm when oil prices were low, but should be somewhat better in this environment. Yeah.
So what would be an avoid for you right now? Which is the sector which you think is not something where valuation supports, and there are macro headwinds as well, which you'll avoid at this point?
Touched a little bit on pharma already, but actually if you look at sectors like consumer staples and telcos, they're still fundamentally challenged in many of the countries that we follow, including in India. So it's to do with competition, it's to do with disruption from technology firms and the reduced power of brands in the traditional consumer staples. And that's something we're seeing on a worldwide basis, including in US and Europe.
Jonathan, the one big argument for India to underperform in 2018-19 is the heavy political calendar year for India. We're going to see some state elections and the general election next year.
Yes.
How much that is a worry for global investors when you talk to your clients?
I don't think they're that focused on the elections next year, but I do think you're right to mention them. And I think, again, what we need to be looking for is whether some of the fiscal discipline that we've seen under this government is maintained in the run-up to the elections or not. It would be quite dangerous to relax fiscal discipline in this current late-cycle global macro environment. So I think that's the main lens by which investors would look at the situation.
Jonathan, when you talk to your clients, both in India as well as in the global markets, what is the general perception towards India? Have they started, losing some faith and they're looking to cut down their overweight positions? Or still a lot of the larger investors are bullish on India? What's the general sense?
So investors are still overweight India, but they're at quite a low ebb in terms of that degree of overweight. They were significantly more overweight in, say, 2015 than they are today. But it is still a market that people are excited about in terms of the long-run growth prospects. It's still a market that has higher ROE than the average in emerging markets and a better than average long-run track record of earnings growth if you go back, say, 10 or 15 years. So, yeah, clients are not in a sort of euphoric state about India, but they are still overweight. Okay.
Jonathan, you track the flows very closely, and the China A-share are going to get included into the MSCI later this year. That will probably cut down the India weight to some extent is what I believe. Will that lead to a bit of pressure in terms of FII outflows, or you think that is pretty much priced in at this point in time?
It's not a huge deal for India because India is not going to lose as much weight as other markets that have a higher weighting in the EM index, say like Korea or Taiwan. But we are recommending an off-index sort of exposure prior to the inclusion of A-shares. We were doing that before they were included, and we would be overweight China A-shares as part of an overweight we have on China. But I don't think it's of huge significance for India.
The other thing is, Jonathan, there were some recent announcements by MSCI that they may look to cap the India weightage, given the problem that the Indian exchanges are having with SGX. Is that a reality? Do you think that can be possible, that the India weightage is capped simply because there is this big, big fight going on between the Indian exchanges and SGX?
Yes, again, I'm not the expert on that, but it's certainly something that I'm aware of, and we've been following quite closely what MSCI have been saying about that. More generally, across the Asia region, what we're actually seeing is exchanges doing greater tie-ups between each other. For example, the Singapore Exchange and Bursa Malaysia in Malaysia. So that's certainly something that is, if it does go through, is somewhat counter to the trend of increased exchange tie-ups in the Asia region.
But will that have an impact in terms of flows into India, or the India perception can change for global investors if that has to happen, that MSCI caps the weightage on India?
I don't think it's as important as things we've already touched on this interview, like the overall economic growth outlook, the fiscal position, the impact of the oil price. But it's certainly something that's worth mentioning. So you're not the first person who's asked me about that.
Sure. Jonathan, what can change your view on being cautious on emerging markets? I mean, what are the few things, if that go right, you might change your view on emerging markets, and you might see a bit of an upside from here?
I think a weaker dollar is important, and the dollar has stopped rising in the last, let's say, few trading sessions. I think it's important that monetary policy tightening, let's say, becomes more obviously towards the end of the tightening phase without damaging growth, rather than just carrying on tightening in the US and China. I think it's important that the oil price doesn't go up too much further, because that's always, it was likely to crimp growth towards the end of the cycle. And then again, it's just naturally sort of earnings growth hopefully coming through, and that brings the forward multiple down. And one of the reasons we were so worried late last year was that the forward PE for EM had reached the 95th percentile of its long-run range. So it is already adjusting lower. So that is why we're sort of healing a bit. But overall, we think it's too soon to go strategically bullish yet.